It is Thursday, June the 22nd, 2017. I'm Gord Long. As is normally the case, I have a lot of charts for us to go through this morning, so therefore I will pass over some of them quickly, but leave you to examine them further at your leisure. You'll need to open your viewer to full screen viewing or you will not be able to see some of the detail I'll be discussing in the charts. A reminder before we begin, do not trade from any of these slides. They are for educational and discussion purposes only. The purpose of the audio is to discuss key developments in those areas not specifically updated in this month's macro online updates. The research document this month updates macroeconomic developments. Therefore, the slides this morning will focus on our other three report areas of our monthly report, the global risk, regional, and U.S. economic developments. As I often do, I'd like to tie them together into a discussion. This month, I'd like to focus on how I believe the central banks may be caught in the first globalization trap. As such, I'd like to discuss specifically the following subject areas. In 2014, our annual thesis was entitled The Globalization Trap, in which we laid out the premise that we would see continued central bank liquidity injections and balance sheet growth, which would foster asset appreciation and a crack-up boom of some form. We felt this part of the cycle would come to an abrupt end when disinflation and real deflation brought on by excess global oversupply, over-leverage, and falling consumer demand would eventually cause collateral impairment to reverse the credit cycle. This would be the first truly global synchronized credit cycle, one which the central banks are, I believe, unprepared for and would not be able to control. Eventually, as a result of unsound money, the global platform of fiat currencies would be found to be unstable and be replaced, likely during a period of economic crisis. We additionally felt a central part of the problem would be as a result of what we referred to as an echo boom. This would be the fallout from excess borrowing by emerging, developing, and frontier markets in eurodollars, thereby tying them to the ravages of financial repression being imposed by the currency cartel being specifically the dollar, the yen, the pound, and the euro. That was the fall of 2013. Well, where are we now? Setting aside multiple signs of a global and U.S. economic soft patch and sluggish inflation, the Federal Reserve did three things during the June 2017 FOMC meeting that lessened monetary stimulus, only the first of which was widely expected by the markets. One, it raised interest rates by 25 basis points. Two, it reiterated its intentions to hike 4 more times between now and the end of next year, including one in the remainder of 2017. And thirdly, set out a timetable for reducing its $4.5 billion balance sheet. These three actions confirm an evolution in the Fed's policy stance away from looking for excuses to maintain a highly accommodative monetary policy, a dovish inclination that dominated for much of the aftermath of the 2008 global financial crisis. Rather, the Fed is now signaling its intent on gradually normalizing both its interest rate structure and its balance sheet. As such, it is now apparently more willing to look through weak growth and inflation data. I guess that is what you do when the data doesn't support what you planned or were required to do all along. On the surface, I suspect the Fed is actually attempting, as one of a number of objectives, to tighten financial conditions, which so far it has been totally unable to do, which is at the root of this continuing speculative bubble I believe we are in. But the speculation is getting much worse instead of better. It is now obvious to all, including the Fed, and everyone remembers only too well what happened during the last two bubbles. The market, however, is simply not buying it, as shown by the yield curve's reaction, with the confusion leading to heightened investor uncertainty. This yield curve reaction should not happen when the Fed raises rates and its guidance indicates further tightening. In parallel, we have seen the central banks of the other currency cartel members also lay out plans to reduce their current rate of liquidity injections, by the way, now totaling approximately $300 billion per month. This all flies in the face of slowing macroeconomic data. This has led to a massive rise in global policy uncertainty, as illustrated here. Political, monetary, geopolitical, fiscal, and economic uncertainty remain entirely unpriced into this market, in my opinion. This is not a good situation, as anytime central bank policy has shifted towards tightening, historically it has led to a financial crisis of some description. This time, what is even more troubling is we have never seen the yield curve flatten to such a degree when a central bank began tightening. This is what is causing, as I said, the anxiety regarding global policy uncertainty. This is as good as it gets before the business cycle turns, and the yield curve simply knows it, in my opinion. If we step back and focus solely on the global picture, away from the Federal Reserve, we see how significant the recent guidance from the Fed, ECB, Bank of Japan, and the Swiss National Bank will have to the rolling 3-month central bank security purchases going forward. What this will do, in theory at least, is to potentially lower the real rates of interest, the real rates. This will also potentially widen the credit spreads. This will put pressure on the large Chinese commodity players, which we'll come back to a little bit later. But is there even more going on here when we consider the detail of the global credit impulse? The surge in global credit in the post-financial crisis era came from a surge in credit in China. This second derivative rate of change has rolled over, as the chart on the right clearly illustrates. A combination of the shift in the currency cartel's monetary tightening policies, which we've just elaborated on, along with China's rate of change, is a little alarming, to say the least. We live in a global economy, more than we actually fully appreciate. Courtesy of fungible money and equivalents, the effect of a credit impulse on one area promptly diffuses around the globe, as credit created in one place often drives prices everywhere, or elsewhere at least. This is the new reality of globalization, which the central banks are really just learning to deal with. Remembering, there are two crowds out there, the BRICS, led by China and Russia, and the developed economies led by the currency cartel. James Rickards, someone who I have a lot of confidence in, believes the actions of the central banks of the currency cartel are attempting to prepare for a global slowdown and potential U.S. recession. I personally believe it is too late. Central banks never lead the market. They react to them. When you consider China in this equation, who is not a real member of the fiat currency crowd, that is, it still believes in gold and in fact continues to buy it aggressively, as does Russia and the other BRICS, then it could simply be a matter that they know a recession is inevitable and are attempting to prepare as best they can after manipulating the markets for nearly a decade since the financial crisis. I think it is too late, and in fact these actions are likely to simply assure that is what will occur, and maybe sooner than the central banks actually believe. They think they may have more time before this happens to raise rates and reduce balance sheets. Some may suggest there are actually even more sinister geopolitical priorities at work that would allow us to make sense out of the global policy uncertainty. I actually believe a fair bit in that, but I'll leave that for another discussion. Let's step back for a moment and consider the impact of the size of the global debt is having on all countries. I've shown this chart in prior monthly reports, so I'll simply highlight what is important here. 1. The central banks of the EU, England, and Japan are fundamentally currently making up for the shortfall in the economic growth required to support the global debt burden. 2. Debt continues to grow while GDP growth is failing to grow. This trend suggests that we can see central banks being forced to increase the level of support going forward, not shrink it by the guidance they are currently giving us. 3. Inflation is failing to materialize, which would lessen the burden of existing debt, a central problem to sovereign countries being able to maintain their current debt levels, or at least debt to GDP. The recent U.S. Federal Reserve's quantitative tightening, or QT as we're now calling it, announcement amounted to a pace so slow that they'll still have boatloads of bonds on board when the next recession strikes. The guess is that they'll be buying again long before they finish normalizing the balance sheet, whatever that really means. Looking at the Fed's disclosed projections, which anticipate the Fed to continue normalizing until 2020 or well past the point the next recession is expected, skepticism is certainly warranted. The market reaction has the level of rates 2 years down the road almost exactly where it was before the Fed hiked, and risk assets around the world are rallying again as the carry party resumes. When the U.S. completed taper and QE3 ended, world stock returns ex-U.S. stocks exhibited a significantly different performance to just the U.S. stock market. Since then, you can see from the pink line, the growth in the U.S. balance sheet has been flat, while that of the Bank of Japan and the ECB has risen dramatically, and as such, all three balance sheets now approximate 4.5 trillion. On an aggregate basis, this is shown here, and we see the slopes of the red highlight lines for the Bank of Japan and ECB rising significantly at that point as they stepped in to the lurch on a global basis. The other central banks stepped up to nearly 200 billion initially. The U.S. market subsequently shot up on the Trump victory, as you can see over to the right side, and expectations of tax reform, stimulus spending, and regulatory reduction, none of which, I might add, have yet to be actually even voted on. We now see that the world stocks have been outperforming U.S. stocks on a relative basis to reflect the increase in the G3, that is, non-U.S. balance sheets. As I've indicated in prior presentations, the central banks established a run rate in May approaching 300 billion per month, as in my opinion, they attempted to quell the global trade and credit slowdown. What we need to consider is that during these central bank normalization announcements, we have witnessed over the last 5 weeks 1.3 trillion of rate hikes bets being unwound, the most ever. The derivative market is signaling there is more pain to come as expectations now for lower rates are everywhere. Another 1.9 trillion of rate hike bets are highly likely to be unwound. This flies in the face of the Fed's supposed tightening. Part of what is being said here is, in fact, about the euro-dollar. I have talked about this many times that we are experiencing a euro-dollar shortage. This is hurting global credit creation. A combination of slowing global trade and a lack of U.S. dollar trade deficit growth are significantly crimping the global economy. This, along with a strong dollar, which interest must be paid on in euro-dollar denominated loans, has become a monumental problem. Previously, this has been averted by the issue by the Federal Reserve of large-scale dollar liquidity swaps. For some reason, and I don't know why, they have not been carried out as of yet. When you add yield to the consideration, as Bloomberg's Tanver Sandhu notes, rates, skews, and inflation cross-currents suggest lower yields to come this summer. U.S. dollar short-dated skews on 10-year tenor remain deeply negative, with receivers trading at a premium to payers. As the chart below shows, the spread between U.S. dollar 3-month 10-year 25 basis point OTM payer volatility and 25 basis point OTM receiver volatility is still negative, signaling expectations of lower rates. Gamma implied volatility remains near all-time lows and lacks any expectations of a significant move. Critically important is the flatness of the euro-dollar curve has been increasingly pricing in the end of the business cycle. U.S. 2-year 1-month, which is a proxy for the Fed's terminal rate, has crumbled to 1.75% along with break-even rates, having required fiscal policy expectations to play out to push neutral rates away from the zero or the term premium to move higher. It has been an unhealthy decline in rates, with real rates higher and inflation expectations lower. Upside for U.S. rates is limited over the summer and is unlikely to see a meaningful sell-off without concrete progress on fiscal reform. U.S. 10-year yield has broken below the July 2016 trend line and 38.2% retraced from the low in the 2.13-2.15% area. A move to the 100-day moving average at 2.36% is optimistic, which has acted as a pivot in recent months. Downside risk extension to 1.96 over the summer, in line with lower terminal rates around 1.75%, is likely. This is suggesting a U.S. and possible global recession is increasingly becoming a worry. In my opinion, the powers to be are worried about the stability of the approximate $700 billion interest and currency swap market. That's at the root of all of this. A market that trades over the counter, unregulated, and is almost completely opaque. It is the area we have been warning about, and many subscribers will remember seeing since we put this grid together on the eve of the 2008 financial crisis. I advise subscribers to pay particular attention to developments in the Eurodollar area and central bank swap announcements. They'll be low key, they'll slip out, but this is what you need to be looking for. My feeling is something is seriously broken somewhere in the global financial community, and things are being temporarily held together, but at any moment are ready to rupture. My sense is that the disruptive impulse stems from China's credit growth and an over-leveraged commodity complex. China's tightening financial conditions, higher short-term rates that is, have crushed not just the yield curve, but global commodities. In their latest global macro outlook note, the Australian bank Macquarie warns that the global economy recently coordinated growth has peaked, which will have implications for all asset classes. They say, and I quote, "The supporting factors for wider commodity markets are now being steadily eroded, and hopes for accelerating global growth and accompanying health reflation are fading. The industrial recovery cycle has matured and is providing less global impetus." End of quote. Once again, we go to the credit impulse and the reflation cycle, which has in recent years originated almost exclusively in China. Macquarie's conclusion for those particularly interested in hard assets is that over the coming months, commodities as a whole look set to face slightly more headwinds than tailwinds. They say they would avoid those most exposed to Chinese construction, given it is currently so strong that the next move is likely to be lower. This means further pressure on iron ore, metallurgical coal, and manganese. In contrast, we expect upside to gold and silver over the coming months as the markets refocus from healthy reflation to deflation potential. We also believe the wider markets has become too sanguine to weather risk in agricultural markets, where we feel risk reward is skewed to the upside. I'm quoting Macquarie here, we would also consider optionality around those commodities where the Chinese government is set to curtail capacity. Aluminum has been widely discussed in this regard, but we would also look at stainless steel, nitrogen, aluminum as those with potential to be next on the supply side reform agenda. And finally, they say on a longer term view, we like exposure to copper, silver, gold, chrome, and eventually oil. We also believe that uranium and potash are at the start of a long crawl off the campus after a tough couple of years. Put it together, you think you can see what's going on here. One last point to consider. The last time the U.S. yield curve was this flat, March 01 and December 07, the U.S. economy officially entered a recession. So, in closing, as I often do, remember the answer will be to print more money as the crisis develops. It is the only answer politicians will ever actually agree on. Invest accordingly. And this will go on until no one wants this money or trusts it. I'd like to take a moment as a reminder, do not trade from any of these slides. They are for educational and discussion purposes only. As negative as these comments often are, there has seldom been a better time for investing. However, it requires careful analysis and not following what has traditionally been the true and tried approaches. Do your reading and make sure you have a knowledgeable and well-informed professional financial advisor. So until we talk again, may 2017 turn out to be an outstanding investment year for you and your family. Thank you for listening.